Bitcoin is at a crossroads. Some are calling this the bottom, while others swear $109,000 was the cycle top. Meanwhile, altcoins keep bleeding as fresh tariff news shows no signs of slowing down. The wait for alt season has been brutal, but so far, all we've gotten is a slow, painful drift away from profits. Is there still fuel left for another leg up, or have we already seen the last hurrah? Today we'll break down whether Bitcoin has topped, analyze Bitcoin dominance and ETH's potential this cycle, and, most importantly, examine the state of US monetary expansion and its impact on market liquidity. If that sounds good, smash that like button to support the channel. Also, the Crypto Decoder community Discord is live and buzzing. Join now for free exclusive content. The link is in the description. Alright, let's take a quick look at the market. Bitcoin is at a critical level after breaking key support around 90K, confirming a bearish breakdown with strong volume. Trading below the bull market support band signals increased downside risk, with sellers in control. If this rejection holds, the next major support is around 73K, where buyers may step in. Losing that could open the door for deeper corrections. To regain bullish momentum, Bitcoin needs to reclaim 90K and establish it as support. Meanwhile, Bitcoin dominance is holding strong at 61%, while the alt-season index has dropped to 31. With altcoins under pressure, a true alt-season might have to wait until Bitcoin reclaims $90,000 and starts pushing toward 100K. Is the cycle top in? I don't think so. Sure, there could be more downside, but it doesn't look like the top is in. We're still in a quantitative tightening phase, and that's likely wrapping up by Q2 2025. More on that later. This 20% dip in Bitcoin doesn't shake my long-term perspective. I've seen deeper corrections. This is my third cycle, and every cycle has had brutal pullbacks. In 2017, Bitcoin dropped 38% before surging 500%. In 2021, it dipped 55% before rallying 150%. If we haven't bottomed yet, we're close. The Bitcoin CME gap is at $77.9 thousand. We might fill it before the next leg up. If you track whales, you've likely heard of Bitfinex whale spoofy. They famously accumulated 70K Bitcoin after the Luna and FTX crashes. Now they've scooped up 4K Bitcoin during yesterday's dip. Smart money is buying. I mentioned this in a video a few weeks ago, but now a lengthening cycle seems even more likely. I'm leaning that way but staying cautious, only dollar cost averaging into large cap altcoins. That said, this is just my take. I'm positioned well enough to manage even if we do slip into a bear market. You know your situation better than anyone. If you're overexposed to crypto, keep in mind there's still a chance that $109,000 was the top. No matter what I believe, I urge everyone to stay balanced. Alright, so when is Bitcoin dominance finally gonna reverse and altcoins get their turn? Every cycle, people start doubting if alt season will even happen. Same old story, this time is different. But then, like clockwork, the same flow kicks in, liquidity rotates, narratives shift, and boom, altcoins take turns with different sectors pumping one by one. The gap between Bitcoin and the rest of the crypto market this cycle is getting too big to ignore. Bitcoin dominance keeps climbing and people are starting to wonder, will we ever get another proper alt season like 2017 or 2021? Is this cycle actually different, or are traders just mistiming things again? The playbook has always been simple. Ride Bitcoin's pump, rotate into alts for bigger gains, then cycle profits back into Bitcoin. Sounds great in theory, but in reality most traders get wrecked, chasing pumps, overtrading, and watching their alt bags bleed against Bitcoin. This time the gap is wider than ever. Big institutions and even governments are recognizing Bitcoin as a legit asset, while most altcoins are looking more and more like pure speculation, or straight-up scams. Without struggling to gain momentum, Bitcoin is holding its dominance like never before. It's gonna retrace at some point, the signs are there if you're paying attention. Back in the 2021 cycle, Bitcoin dominance got smacked down twice from the 64% region in February post-halving. It consolidated around 62% in March, then nuked an insane 38% from rejection to the May alt-season blowup. Fast forward to February 3rd this year, Bitcoin dominance hit that same 64% level and got slapped again during the tariff sell-off. Not saying history repeats exactly, but it's definitely worth watching. If we're in for a proper alt season like 17 and 21, Bitcoin dominance needs to bleed down to that reversal zone around 42%. ETH needs to take the lead as the second largest crypto asset for things to really take off. So far, its performance this cycle has been sluggish, but it can't get much worse than this. We're likely around the bottom. I've been stacking ETH around the 2.5k range just like I mentioned in the last video. I've also placed some stinky bids below 2k and am happy to DCA without worrying about catching the exact bottom. The goal is to build a solid position before momentum kicks in. I'm also watching the ISM PMI, which tracks economic activity in manufacturing and services. ETH tends to perform well when this index is above 60, signaling growth, while anything below 50 points to economic contraction. The ISM matters because it reflects overall economic confidence and liquidity conditions. During the 2017 and 2021 bull runs, it spiked above 60, setting the stage for a risk-on environment where ETH and alts went parabolic. During the 2017 cycle, when ETH reached its all-time high in January 2018, the ISM was at 60. At the 2021 all-time high, the ISM stood at 61. Currently, however, the ISM is at 51, indicating contraction. ETH, like other altcoins, performs best under looser monetary policies, and we may see that sooner than expected. This chart offers a compelling look at where the dollar and interest rates might be headed, and the signals are pointing toward further downside. At the core of this trend is the relationship between US economic surprises and how they compare to the rest of the world. When economic data in the US consistently falls short of expectations while other regions perform better, the dollar tends to weaken and bond yields start to drop. This isn't just a coincidence, it reflects a shift in market expectations around future monetary policy. A weaker US economy relative to its peers makes investors question whether the Federal Reserve will be forced to take a more dovish approach compared to other central banks. That's when capital starts flowing out of the dollar into other currencies or assets, and bond yields begin adjusting lower as the market anticipates rate cuts. You can see this play out in the chart. The black line, which tracks US economic surprises, has been trending downward, showing that recent data releases have underwhelmed expectations. Historically, when this happens, the dollar follows with a slight lag and bond yields soften as well. The reason this happens is simple. If the US economy is slowing while others remain stable or improve, the Fed has less room to keep rates high. That reduces demand for the dollar because other central banks may be maintaining or even increasing rates in comparison. The bond market reacts similarly, with yields dropping as traders begin to price in a shift toward easier policy. Another key point here is that markets don't move based on absolute numbers. They respond to relative shifts. The Fed isn't making decisions in isolation. It's being weighed against the European Central Bank, the Bank of Japan, the Bank of England, and others. When the US is underperforming on a relative basis, the dollar and bond yields tend to move lower. If this pattern continues, we could see further weakness in the dollar and a sustained decline in bond yields over the next few months. That would set the stage for a more favorable environment for risk assets, as lower yields and a weaker dollar typically provide support for stocks and crypto. Of course, external factors like inflation shocks, geopolitical events, or a sudden change in Fed messaging could shift this trajectory. But if current trends hold, this chart suggests that a weaker dollar and lower rates could define the next phase of the market. This could signal the end of quantitative tightening by Q2, creating a bullish backdrop. The Federal Reserve's January FOMC meeting minutes were just released. Tomas shared a great post breaking down what this means for the Fed's next moves and when we might see the end of QT. Let's break down the key points from this Twitter post. The Fed just signaled they might pause quantitative tightening because of the debt ceiling issue. They're not ending QT, just slowing it down for now. QT is draining $55 billion a month from the system, but if they pause it, that pressure on bank reserves will stop. However, we cannot expect a big surge in liquidity unless there's a major crisis. The debt ceiling is crucial because it affects how much cash is in the system. Once it's resolved, we could see more reserves, but that might quickly decrease when the Treasury account is refilled. In short, the Fed is watching liquidity carefully. QT might pause, but a big QE boost isn't likely unless something major happens. Even before the Fed minutes were released, major financial institutions were already predicting that QT would end sometime between Q2 and Q3 of 2025. So, the idea of QT winding down wasn't new, it was expected to happen anyway. The Fed's latest statement just reinforced that expectation. Sentiment is rock bottom right now, even though Bitcoin and digital assets adoption is accelerating. All we need is a macro push. Looser monetary policy will spark a run that could wipe out months of losses in just one daily candle. Seen it happen in 2017 and 2021. This ain't the ICO boom of 2017 or the DeFi summer of 2021. This cycle's different. Tech and financial infrastructure have leveled up big time. fundamentals are stronger than ever. Back in the day, altcoins were mostly just speculation, but now many have real utility, institutional support, and growing adoption. If you've made it this far, giving up now makes no sense. Capitulating at this stage would be a mistake. With looser monetary policy, institutional interest in ETH will explode, setting off a chain reaction that fuels alt season. This next wave of alt dominance will be driven by utility, adoption, and real-world integration. ETH leading the charge in DeFi and RWA adoption. Alt season is inevitable. It's all about positioning yourself in the right narrative. If you've been in crypto long enough, you've seen this play out before. Liquidity will flow and the profits will be there. The real question, will you take them or get greedy like most? Don't wait until it's too obvious. By the time the herd catches on, the best opportunities will be gone. May the gains be with you. See you in the next one.